Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, it's Augustino. Raising money from investors is not a do-it-yourself project. Some have tried and flown under the radar without any issues. Others have just gone to jail. So partnering with the right people is absolutely paramount. Today's guest, he's actually been on the Bulletproof Cashflow podcast before, where as a real estate entrepreneur for nearly 20 years, he told us about how he sold off a staffing company and then he pushed hard into real estate. In the early 2000s, he entered the real estate sector doing house flips, but then he eventually migrated to multifamily and big commercial stuff. Today, he and his partners are focused primarily on capital raising by forming partnerships with expert operators who develop ground up and value add assets like self-storage and multifamily. So rather than syndicating one-off deals, he uses investment funds as the mechanism to raise his capital from investors. He is the author of The Perfect Investment, Creating Enduring Wealth from the Historic Shift to Multifamily Housing. And he co-hosts a podcast, How to Lose Money, where he interviews guests in the multifamily and real estate game. So with all that, I'd like to welcome my good friend, Paul Moore, to the show. Hey, man, thanks for coming on. Appreciate it.
Hey, Augustino. So great to be here again. Thank you.
Excellent, excellent. Well, before we go on, if you like what Paul has to say, you can reach him over at wellingscapital.com. And don't forget to check out his podcast, How to Lose Money. Or you can get there at the URL, howtolosemoney.com. So, okay, go ahead, Paul. Tell us a little bit about what you've been up to since the last time we spoke.
So just to kind of overview, when I got into Class B value add multifamily, I felt like I told my wife, I said, I should have been doing this all along. I wish I'd have known in my 20s or even 30s or even early 40s what I learned about the value formula in commercial real estate. And real simply, as your listeners probably already know, if you're in residential real estate and you fix up a house, let's say you're Chip and Joanna Jr., and you fix up this house to be this amazing level. Let's say you put $500,000 in this house. If the other houses on the block are $350,000, you're not going to get the value out of that. You're limited in residential real estate by the comps, by the comparable properties. And residential is generally considered, anywhere from 1 to 3 or 4 units in a small multifamily. But the value formula in commercial real estate is so powerful. The value, just to kind of as a reminder here, the value equals the income divided by the cap rate. So it's the value of the property is the net operating income, or the NOI, and that's not including the debt service, divided by the cap rate. And the cap rate is the capitalization rate which is basically the rate of return that an investor would expect, the unleveraged rate of return that an investor would expect for that type of asset in that market at that time. And so if you can increase the numerator in that formula, and if you can compress the denominator in that formula, and there actually are things you can do to change the denominator, even though some people say you can't, then you can dramatically drive value, increase the value of your asset. And with leverage, you can even dramatically more increase the leverage to, increase the equity return. So quick example, if you can increase the income at your property by $1 a month, okay? Just $1. That means you increase the revenue by $1 or you decrease the cost by $1. That is, I'm really good at math. Watch, $12 a year in increased in income. But when you divide that by a cap rate of, let's say, 6.5%, I believe that $12 by 0.065 is about $200 increase in value. And so this is like Jeff Bezos taking the lights out of the vending machines and all the snack machines and all the Amazon facilities, because he said, why waste the electricity? Why waste that light bulb? Because his price to earnings ratio of Amazon stock, let's say it's 20 to 1. That means every dollar he can increase the income, he can increase the value of the company by $20. It's very similar in commercial real estate, but it's even better for the equity investor because $200 increase in value to the asset at a 60% leverage amount, let's say that there's a 60% loan to value ratio, you can multiply that $200 impact at the asset level by 2.5x. Okay, you can do the math on that. With a 60% loan to value ratio, you multiply the impact on the equity 2.5x, and that is the impact on the equity investor. So let me ask you, Agostino, if you can increase the lot rent at a mobile home park by $20 a month times 12 months times 300 lots, what's the impact to the investor? It's huge.
It's huge. Absolutely.
If you can, decrease marketing costs by a little bit, or if you can, build, like a friend of mine, one of the guys we invested with just had an acre of weeds at his mobile home park, and he fenced it in real nice. He paved it, and he spent only $100,000 doing that. But now he's leasing out lots in there, and he's saying, oh, by the way, if you have more than 2 cars at your mobile home, you have to lease a space in here. If you have a boat, jet ski, RV, or whatever, you have to lease a space in here. He's able to increase his revenue by, get this, $10,000 a month by doing that. 10,000 times 12 months. Well, that is $120,000 a year. Divide that by the 6.5% cap rate. And if I remember the math right, that comes out to about $2 million. Now, if he paid $5 million for this mobile home park, he got $3 million in debt, $2 million in equity. Now, he just increased the value with that one change, without not even including raising the lot rent and all that. That one little fenced-in area just increased the value by $2 million. Guess what? He just had 100% appreciation to the equity. Now, it's going to take a couple years to lease that acre up, but over a couple years, 100% increase in equity by one change. That's powerful. And that's the kind of value you can drive in self-storage and mobile home parks and multifamily and other types of commercial real estate. So, like I said, when I hit about 50 years old, I realized this power, and I said to my wife, I'll never do anything else. I specifically said I'll only do commercial multifamily. I know this is a really long answer, but I realized over the last couple of years that multifamily has become largely overheated.
Yeah.
You're in Akron, Ohio, and I'm in Lynchburg, Virginia, and these, tertiary towns, multifamily is really, really overheated. So I've decided over the last year, Wellings Capital has decided to look outside multifamily only, and we're looking to invest in self-storage, mobile home parks, and more. And I think I might have mentioned that on your last show, but we can talk a little more later on the podcast how we're doing it. But that's still where we're at.
Yes. Well, I mean, it's part of how you're doing it, though, is you did set up the growth fund, right? The Wellings Growth Fund as the mechanism to kind of move into that space, or is there something that happened before that?
Yeah, so last year we invested in a couple of different syndications on a one-off basis, and we really liked that. But we really felt like, for investors' sake, we'd be better off, with a potential of recession of some type on the horizon or some type of downturn. We thought it would be better to, give them diversification across a lot of different assets. So we decided we would like to diversify across asset classes, operators, geographies, and assets. And to do that, we set up a fund. And as we were setting up the fund, we realized, gosh, some of our investors really want income. They want to make 7 or 8% a year, for example, from the asset and from their investments. And they also are hoping to get the appreciation. We can serve them. But there's other investors who don't want any income, and they would rather just see it multiply and, hopefully exponentially grow inside the fund. And we realized, gosh, we can't serve both of those in one fund. So we actually set up 2 funds. We set up the Wellings Growth Fund 1, and that's all about appreciation. And we're trying to find assets like steep value adds, ground up developments in multifamily and self-storage. And we're trying to plow that money back in and turn it maybe a couple times, let's say in 7 years, and give the investor as much appreciation as we can. Then we set up the Wellings Income Fund 1, which has appreciation, but its main goal is to find assets that are already providing income day one. And we're looking for assets in the self-storage, multifamily, and mobile home park space for that fund. And we're investing in those as well. So that's what we're doing.
Nice. Excellent. So the big difference then between doing the fund and the syndication is that obviously with the syndication, the asset is already selected. You're raising it from a pool, and everybody's funding that one asset. In your case, though, with these funds, it's different because people are putting money into the fund and you're investing in multiple assets then, right?
Right. Mm-hmm.
So how does that work then? How do you make that split off? If, say, I throw down 100K, how do you guys determine what goes where?
Yeah, like I said, so we're trying to diversify across those different groups. We are actually investing in the income fund. We have one operator who's already very diversified. They have, at this time, Augustino, they already have 19 assets they've invested in. So when an investor invests with us, we're investing in 19 assets by writing one check, and they're actually growing that group to about 30. And that's a group of self-storage and mobile home parks. And it may sound like just a fund of funds, but here's the difference. This fund has given us a wonderful break, if you will. They're basically effectively, by the deal they've given us as a large investor, they're effectively funding all of our charges, all of our costs to administer our fund.
Wow.
Which means we are effectively passing through the same or slightly better return to investors than if the investor went directly to them. So there's actually an advantage to putting it with us, and we're giving the investors a diversification because we're investing with them and others. Now that's the income fund. The growth fund, we are looking very, very carefully because there's higher risk. We're looking very, very carefully at every operator, first and foremost, and then their geography, and then the asset level. And we've turned down a whole bunch of potential deals and operators that we are actually friends with, that we really love, but for one reason or another, we didn't feel comfortable with the geography or the deal or even their team. There are some great teams, but they're not super seasoned. They haven't been through the last recession. And we really want to go with people like the operator in the income fund I mentioned. They've actually been a company for 42 years, and their senior management, about 5 of them have been with the company 33 years or more, which is amazing. And that team knows how to go through good times and bad as a cohesive unit, and we really favor them for that reason.
Right. It's funny. In my podcast, I often talk about building your team, and I think it's the same thing goes for selecting who you're going to work with as well. So it seems like, just for clarification for the audience, it isn't like you found a great 12-unit deal, they're going to give you a call. You're looking for seasoned individuals that have been doing this for a while, that have a great geography, a great return, and it sounds like preferably them or of them. Is that one of the criteria as well?
It's not an absolute criteria. I would rather have a seasoned, amazing, highly ethical, value match type team that I don't currently know than one that I do know but doesn't have all those qualifications met.
Yes. Yeah. Now, before you started all this, what were some of the considerations you have to take into account as far as even you decided you're going to do this growth fund? What did you have to do? Like, did you have to go off and engage your syndication attorney or SEC attorney rather? And how did that whole process work?
Yeah, we did some investigation, and then we engaged an SEC, syndication attorney, and we had them draw up the paperwork, and we met with them. We filled out questionnaires. We went back and forth with the documents. We filled in all the blanks, if you will, on an operating agreement, and then the PPM, which is a private placement memorandum, the subscription agreement. We got that all drawn up, and we did that basically in November of last year, and then we launched January 2nd this year.
Did you consider doing it as a debt fund? And maybe for those that don't know what the difference is, an equity fund versus a debt fund. The debt fund is more like a loan type of product, right? Where an equity they're actually putting down. It seemed to me like it was fairly clear. You already decided it was going to be an equity fund, right? Right from day one.
Right. Yeah, we hadn't really thought about a debt fund, but we will at some point. There's going to be investors who don't want returns from let's say the growth fund. We're going to refinance assets, and we'll be actually throwing off some income. And some of those investors have already told us, we really don't want that money back. We just like to see you plow that back into something else. Well, there may come a day, either within the 7 years of that fund or at the end of that fund, where we want to reinvest that in something safe, stable, maybe a little lower return that doesn't have the potential downside. So we might do a debt fund at that point.
Okay. Oh, and now I wonder in a debt fund then, would they still get, they wouldn't get any ownership in a deal then? It would just be almost like drawing from a line of credit almost, right?
That's probably how it would be. There's a chance there would be a equity kicker involved. We'll see.
Nice. Good. So how do you determine the investor returns in a case like this? Obviously, it's very different than syndication where you have one deal and you're relying on the performance of that one deal. How does it work in this case where there's a variety of different assets that all perform a little differently? How do you determine what you're going to tell Mr. or Mrs. Investor what their return is going to look like?
So how do we determine our targeted or projected returns?
Yes.
Yeah, so I'm a real believer in the margin of safety, which, Warren Buffett talks about and engineers talk about all the time, the safety margin or the margin of safety. And so one of the companies we invest with in the growth fund, for example, and you can go back to the example I gave about 10 minutes ago about the mobile home park that, doubled, potentially, I should say, I didn't say they doubled, but they potentially doubled the equity value by that one change that they made by adding the paved area. We invest with people who had a history of steep value adds like that and operators who have had much, much higher returns. And then, of course, we imagine the possibility that cap rates are going to go the other way in the next several years because we've had a long, strong run, right? It's, we're only 4 or 5 months away from the longest expansionary period in U.S. history. 5 more months and we'll be there. It may not go that way. So we're taking the historic returns, we're matching the current deal to those historic returns, and then we're saying, okay, well, what if the cap rate goes the other direction? What if income doesn't increase at that amount? What if they're not able to hit those targets? And so we apply the safety factor, which basically means we, in many cases, would cut the returns approximately in half. And then we take a little more off, and that's where we often paint as our target return for the investor. So, and I'm not literally saying that the returns are going to be double what I'm projecting. Not at all. What I am saying is historically, they've been able to hit returns that were, something like double or even more than we're projecting now. But again, it's been a long, hard, strong run, and that is not going to continue in the future.
Correct.
It just can't continue at the rate it's been going.
Now, do you think investors are aware of that? I mean, do you think that they know the type of returns that they've been seeing over the past several years? It can't possibly continue. Do they know it's not sustainable?
I don't know. I think some investors, by the behavior of some multifamily syndicators over the last couple of years, I kind of wonder if maybe they think it will continue and maybe they think this is the new normal and maybe cap rates, that were in the 8 or whatever percent range, now that are 5% range, maybe they really believe they'll continue to go and we'll end up like Europe or Israel or Australia where the 4% or even 3% or even 2% is the norm. Hey, Augustino, maybe I'm wrong. Maybe that will happen, but I wouldn't bank on it.
Right.
Those who bank on appreciation are destined for trouble. And I think, you would agree that cash flow is where we want to guarantee, we want to make sure we have cash flow. I had an investor operator named Rod Cleef on my show once. Rod told about how his net worth increased like $30 million in Florida in 2006. And then between 2007 and 8, I think it dropped 50 million. And he lost everything. He said, by the way, if he would have just been in multifamily, he wouldn't have lost it. But the single family homes that dropped 55% in value just crushed him. And because he was counting on appreciation more than cash flow.
I remember that. It was insane. That the markets back then were just nuts. It was nuts. Mm-hmm. So now, for people that are getting started to do this, so if someone's been a syndicator for X amount of time, they've syndicated X amount of deals, what do you think that X is before they should start doing their own fund? Or is it more strategic as far as doing it because the market dictates it? Because it sounds to me like setting up an investment fund today makes a lot more sense because of where the market is shifting and where you believe, and I believe too, that there will be a little wobble in terms of the recession. There's going to be a little glitch coming up. I feel it. I see it. I mean, but is it because of the function of that, or do you think that a syndicator really needs to have a lot more experience before doing this?
I think it just depends on what you want to do. So at one end of the spectrum, you've got control and all the hassles that come with and all the experience you need to operate deals. Okay, you've got the control, but you've also got all the weight, all the responsibility, and all the difficulties of asset management, of finding the right deal in the first place, of signing on the debt, trying to get the best non-recourse loan for your deal, having the net worth and the liquidity available to do that, by the way, all the different barriers to entry, but you do have control. That's one end of the spectrum. At the other end of the spectrum, you don't have control, but you don't have the responsibility of finding the deal, finding the debt, signing on the loan, and the years of headaches with asset management and overseeing property management. So, but you forego control in exchange for all that. If you're the type of, I think it more is a function of the type of person you are, and the type of team you have. If you have a team that's done the asset management, property management, signed on the loan, have a years or even decades of track record, like the one I mentioned earlier, that we're investing with, great, do it. Keep the control, keep the extra profits, enjoy yourself. But if you're more like me and you want to specialize in working with investors and you're willing to forego control because you trust great operators, then maybe you should consider a fund and doing what I've done. That's where it came down to for me, because I realized, 5 years into this, we didn't have the team to do self-storage and mobile home parks. And yes, I could have gone and assembled that team. I could have found those people, but I would rather raise money and trust existing operators. It's sort of like Warren Buffett and Charlie Munger. They made a decision after a couple pretty significant failures back in the 50s, I believe. And I'm thinking of one of them. There was another one I can't remember the name of, but in operating their own companies, they realized, hey, we'd rather bet on great jockeys rather than operate the horse itself.
Yeah.
Generally, Warren and Charlie don't operate companies. They don't go out and do all the mechanics of doing it. They trust people to run companies. So they trust the owner and the operator of Clayton Homes. They trust Coca-Cola. They trust these different companies, and they invest with them and their operating team. And I'm trying to model myself after that.
Yes. Okay. So getting back to the investors then, an investor that you're going to interface with, they're typically going to be investors already in real estate, I imagine, right? Typically what you're finding?
Not always, but they're often already interested in real estate. They came to us through Bigger Pockets or some real estate podcast, typically.
Interesting. Okay. It's a little different than in the world of syndication. I find that the people that often throw down in our deals, they are either in real estate or they have some experience with real estate or they want to get into real estate, one of the three. But very rarely do we find anybody that's never done any type before. It's very hard for them to part that cash. That's all. It's interesting.
Yeah, I mean, most of our investors have some background in real estate or some interest, and a lot of them have done single-family homes, and they're just sick and tired of dealing with toilets, tenants, and trash, and they realize they could make just as much or more money as a passive investor, and they could just enjoy their life.
Exactly.
I say to them, why work harder than you need to make less than you could?
Yeah. I would imagine maybe some of them think they have more control, but at the same time, if the bottom line is still the same, then why would you do it? Right? It doesn't make any sense.
Right.
So now what does the reporting side look like? Since now you're running the fund, is it very similar to how it works in syndication where you're still reporting on a quarterly basis? You're still delivering the returns, they're still mailing the checks. Like how does that part work?
Yeah. So we're trying to give monthly updates, even, little updates for the first year, and then major quarterly updates, where we do a written report, possibly a webinar. And then at the end of the year, they're getting a K1 and a more full report on what happened with the assets that year.
Nice. You typically get a lot of questions, or they pretty much take it, read it, and...
A surprisingly few amount of questions. They're trusting us to maximize the return on investment. And there's not that many questions along the way.
Okay. All right. Good. So when you're onboarding these guys, what do you find is typically the one question they ask before they invest in the fund, like a very tough question that they ask that you have to overcome, so for an objection or anything else like that? What's the one thing?
If they're smart, they're going to ask, how do we vet this operator? Do we really know this operator? How well do we really know them? How well are they going to manage? They don't get to know the operator directly. They get to know us, and we have vetted the operator. So they should be asking how much due diligence we did on the operator, the geography, the asset, et cetera. And they also sometimes ask, why shouldn't I just go directly to this operator? And then we tell them what I told you earlier, and that we got a sweet deal that allows us to get a higher return that offsets, and sometimes more than offsets, our fees. And so those are a couple of the important questions people ask.
Well, not to mention too, when you're also spreading the risk, so to speak, even though it's not really a risky business to begin with, in my opinion, but I'm a little biased, but it's not really a risky thing. You're investing in multiple asset classes. And I know that self-storage typically trails multifamily in terms of how the progression curve looks as far as its valuations are concerned. But still, to invest in those sorts of asset classes, they're just winners. They're just awesome. Great cash flow.
Yeah, they've historically done very, very well, and they've dipped less during recessions. If you think about it, tenants in self-storage and mobile home parks are stickier than most areas. For example, mobile homes. They're paying $300, $350 a month. They're already at let's be honest, the bottom of the chain. There's home ownership. And by the way, a lot of this is based on preference. But when you get in these lower price asset classes, it's not preference anymore, it's necessity. So you've got home ownership, you've got a home rental, then you've got apartment rental, and you've got there's some scale down to mobile home park ownership or mobile home park renting. And some of the people in mobile home parks, where are they going to go? If they get mad because you raise the lot rent, they're paying $300 a month in rent. If you raise the rent by 8%, I should have done the math before I said that. Let's say 10%. So you raise it by $30 a month. If that's the market rent, $330, they're probably not going to get mad, spend $5,000 to move the mobile home down the road to save $30, especially when that operator could raise it $30 next month, And so it just doesn't make sense for them to leave. Self-storage, think about it. Somebody in a downturn, they're downsizing from their 4,000 square foot home to 2,000. They might need a place to store their stuff. They're downsizing from a 2,000 square foot home to an apartment. They might need a place to store their stuff. And for a relatively small amount of money, they could do that. And like the mobile home people, they're probably, if I'm renting an apartment to you for $1,000 a month and I raise your rent by 6%, you might move rather than spend the $60 a month for the next couple of years. But if you're in a self-storage unit, and you probably are the mindset you're not going to be there long anyway, by the way, and I raise your rent 6%, well, if you're paying 100 and now you're going to 106, you're probably not going to spend a Saturday, rent a U-Haul, get your friends, sweat, and move all your junk, treasures, down to another storage unit down the street to save $6 a month. It's probably not going to happen. And so tenants are very sticky. And so that's what makes these two asset classes particularly recession resistant.
Yes, absolutely love them. Now, what should I ask you that I didn't know enough to ask?
That's a great question. You might want to ask about the cap rates. Okay, so what about this?
Talk about that, yes.
You say, Paul, that self-storage is recession resistant. Why is there a sudden rash of self-storage units going back to the banks? Why, when the foreclosure rate was virtually zero in the last recession, similar to multifamily, by the way, why is there a sudden number of self-storage units being foreclosed upon? And the answer is people went too crazy. Self-storage is a little bit easier to build than multifamily. It's a little bit quicker. It's a little bit less expensive to build. And so people were going crazy, and they just had this attitude, which was true in the 80s and 90s, by the way. If we build it, they will come. And that's just not true, obviously. It's just
Right.
economics 101. And so some people would go into an area that's already overbuilt and build a new self-storage facility. And they'd say, well, we're going to make it look really, really cool. We're going to do an arts and crafts look, like the arts and crafts area here. Or we're going to make it look like a beautiful horse stable because it's in horse country. Well, that's not going to necessarily drive people to leave. Remember the stickiness, their current steel building self-storage to come to you and pay $30 more a month, by the way. And so some of these folks, self-storage, unlike mobile home parks, which are not being built, self-storage can still be built. And sometimes they're oversaturated. So I know of a self-storage facility in Charlotte, North Carolina, that was built in an already oversaturated area, and they were leasing up much slower than they planned. They finally realized recently that it was going to take 2 more years to get to stabilization, which was like 85 to 90%. And they realized when they got there that the value of the facility would probably be $6.5 million. They spent $9 million building it. So they turned the keys into the bank and they walked. Now, that is happening in self-storage. So self-storage, not exactly like mobile home parks, which are very different. Self-storage, you have to be really, really careful. You can love the asset class, but be really, really careful where you're investing and who you're operating and who you're investing with. I'm thinking of more stories as I'm sitting here. I know another one where a guy's building a beautiful facility. While he was building it, a Sears store in the area shut down, and somebody's building, I think it's $100,000 of retrofit self-storage in that old Sears store right down the road. And they're going to be able to do it for a fraction of what he's spending to build this state-of-the-art new facility. Guess what? I think he's not going to have an easy time leasing up and getting his money back out of that. So what I'm saying is be really, really careful. On the other hand, by the way, we're investing with an operator in the Pacific Northwest who got an old Kmart building. He sold off the parking lot. He had $2.5 million of his own cash in it, $5 million in debt. So he had $7.5 million in it. He is at 40% lease up at the Super Kmart, by the way. It's in Reno, Nevada. And he just got an offer. Remember, he has $7.5 million in it. $2.5 million of that's cash. He just got an offer of $25 million from a REIT.
Oh, beautiful.
And he's only leased up about 40% right now. So he's going to make, if he sells it for that amount, he'll make something like 900% on his cash in about 3 years. So it can be done. Just be really careful where you do it.
Yeah, exactly. I looked at self-storage for a while and I love that business. But the issue is, just like you said, you have to be very much aware of the competitive forces that are nearby. It's very different than multifamily, which I know very well. When people walk into an apartment, it's an emotional attachment to the property. They love the property. They see themselves living there. In a storage unit, they don't really see themselves living there. So it's really just a place to put their junk or their treasures, like you said earlier, right? Their treasures, right? To put their stuff, and they don't really care if it has a barn look and feel, or if it looks like an artsy type of like an arts house or something. No one cares. They don't care about that. So, and not to mention too, like you said, the competitive forces that are nearby, if you're not prepared to handle that, or you didn't do the proper due diligence, you get burned. So that's the biggest part of it. So yeah, finding the right operators that are aware of all that kind of stuff is so critical.
Yeah.
So critical.
Right.
Yeah. I'd love to get in a deal like the one you just talked about, though. That guy is going to do very well.
Me too. I did not invest in that one. I didn't know him at the time, but I am talking to him. We talked several times over this weekend trying to find another deal like that.
Yes. That'd be another show then. How do you select that market? That's going to be a very
let's do it.
Interesting show right there, because I imagine that, like I said earlier, finding the right spot and then deciding that that's the right one is going to be the kicker right there.
Right.
Well, let's move into the bullet round. All right. So let's do that. So tell me, what do you think the next 5 years looks like for your business?
So I can see Wellings Capital opening up a new fund in the growth and the income fund arena every year, maybe for the next 5 years. And we'll just continue to operate these new funds, and we'll invest as well as we can. And the growth fund will continue to turn that money into other deals as deals refinance or close out. And the income fund will be refinancing in years approximately 3 to 6 the assets, and then handing the money back to investors and keeping their positions in the investments. So by opening up another fund, let's say in year 3, 4, 5, while those are being refinanced, we're giving investors an opportunity to reinvest their principal, tax-free, by the way, somewhere else while their money is growing in that first fund as well. So I think that's what we'll be doing.
Awesome, Dylan. So tell me about what motivates you. Like, what's your philosophy for life and success?
Wow, that's really hard. I really think we all need to have a big why. I'm reading Principles by Ray Dalio, the most successful hedge fund investor of all time with Bridgewater. He just made $1.6 billion last year. That's in retirement, I think. Anyway, he said that people above about $90,000 or $100,000 in income and above are no more happy than those at that level. So in other words, you can make $90,000 a year or $90 million a year or more, according to him, according to the statistics he studied, and be no more happy. And so you got to have a big why.
Yeah, I heard about that. I'd still rather make 90 million though.
Yeah, let's try that. So anyway, but of course, then you get the hassles and all the trouble you get with the additional money. But I want that trouble because I want to change the world. And I figured as long as my heart is beating, as long as there's breath in my lungs, I might as well change history. And I really want to do that. Have we talked about human trafficking before?
Yes.
Yeah. So just to kind of reiterate that, if I was alive in the 1860s, I want to believe I'd be fighting for the freedom of slaves. If I was alive in the 1960s, or at least an adult, I want to believe that I would have been fighting for civil rights. Well, there's a civil right that's been ripped away from tens of millions of people who are enslaved around the world. And it's come through, human trafficking. And so I want to invest. I want to get the word out, and I want to raise awareness. I want to raise money. And I'd like to see $1 billion in my lifetime put toward fighting human trafficking and rescuing its victims. It's a huge tragedy. If you took the record profits, not the average, the record profits of Apple, GM, Nike, and Starbucks, combine those, double that number, that would be less than the current revenues generated through human trafficking right now.
Wow.
Which is incredible. And it's a tragedy, but it's not making headlines. It's not causing a civil war like we saw in years past, but it is every bit as devastating, especially to these individuals and their families.
That's a very big why. It's a very big why. It's an important one too.
Yeah.
Absolutely. So now what are you tired of, and what's exciting you?
I am tired of, as an entrepreneur, I have for many years been tired of chasing shiny objects. And now I've gotten to the other extreme where I'm actually pretty cynical about new deals, new operators, new asset classes. And so I think my wife's kind of tired of me being cynical now, because I question everything. I question this latest health craze or this latest alternative medicine treatment that she comes up with or whatever. And so I have just become, instead of just being the chasing shiny objects guy, wireless internet sounds great. Oil and gas, that sounds great. I realized why in years past, the people who I knew who were the best investors said, no, I don't invest outside of what I know personally. I realize why now. And that's the attitude I've adopted. So I guess you could say in the flow of my life in general, I'm tired of chasing shiny objects.
Excellent. All right, guys. If you want to follow up with Paul, you can reach him over at his contact page at wellingscapital.com. Also, check out his podcast and his book. It's awesome. All right. There's so much value in this discussion. Thank you so much for your time, Paul. I appreciate it.
All right. Thanks, Agostino. Have a great day.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.